Hey guys, this video will be the work together 11-2. Let's go ahead and read the problem on page 331. A general journal and selected accounts receivable and general ledger accounts for Klein Interiors are given in the working papers. Your instructor will guide you through the examples. So using the current year, journalize the following transactions on page 6 of a general journal. Source documents are abbreviated as follows. A credit memorandum is CM and a sales invoice is S. So right away, I like to get the page number on the paper so I don't forget. General journal, here it is. We just have the date, account title, document number, post reference, and just a debit and a credit. There's no column titles or anything specific that we need to worry about. It looks just like our regular T accounts. So we'll start with the first transaction. We granted credit to Keller Associations for merchandise returned, $245, plus the sales tax, $14.70, from S, which is sales invoice 645. The total was $259.70. CM28 is the document number. So we learned this in the intro video. When we grant credit to someone, we are putting the amount back into their accounts receivable, just decreasing it out of their accounts receivable so they no longer pay it to us anymore. And we put that amount in a new thing called sales returns and allowances. We also debit whatever the sales tax payable is because that means we never really made that sale. We don't need to pay sales tax on it. They returned it or we gave them some kind of allowance, but it was never truly a sale because we finally returned it. Or we had it. We had the merchandise returned is how I should say it. So the date is June 4th, and that's where I'll start. And so we learned that the normal balance of a sales tax, or sales returns and allowances was a debit. That means it increases on the debit side. So we granted credit to Keller Associates for merchandise returned. $254 was the return. So I go ahead and write down in the debit $254. That is the sales return. So sales return and allowances. We use both terms here. The document number was CM28. We used the one that's at the end. Okay, like I said, the sales tax is not returned back, is not have to be paid. So we're getting it back. So we're going to write sales tax payable. And that would be for $14.70. Okay. Finally, we have a total of $259.70. That's what's going to be subtracted out of Keller's accounts receivable. They no longer owe it to us, so we need to get it out of their account. Accounts receivable is what we'll put first. Same thing like we did for the accounts payable. We put the general title first, accounts receivable, and then a nice little slash and the specific company, Keller Associates. I'm going to abbreviate that. Okay, and that's for the full amount, the $259.70. They no longer owe us that. If you notice, these two added together equals this. There's two accounts here, so I have to put the slash because I will post it in two different places. Typically, if you draw a slash in here, you have to draw the slash there. This shows two different, this is the general ledger, this will be the subsidiary ledger, accounts receivable ledger, and we put the slash in there to post. Good, let's go on to the next one. We learned that a sale on account to Ashton and Lindsay's LLP was incorrectly charged to the account of Abraham Corporation for $623. Memorandum number 61. So this was on the 9th. So this means when we made a sale on account to Ashton and Lindsay's, it was incorrectly charged to the account of Abraham Corporation. So we showed it in Abraham's Corporation. I want to draw this out in T accounts for you. So a little T account here, T account here. And when we have a sale on account, we are going to receive money. So if someone is taking out money, this is the normal balance side. And we sold something on account to somebody, it should be a debit to increase that. Well, we have two people here, Ashton and Lindsay versus Abraham. Missing an A. Okay. And so we incorrectly, let's read that. A sale on account to Ashton and Lindsay. So it should have been an increase for Ashton and Lindsay of the $623. But instead, we recorded it in Abraham's account. So it looks like Abraham owes us $623. And if we didn't write anything down, then it looked like Ashton and Lindsay owed us nothing. So we pretend that's not here. So it looks like Abraham owes this, but it's not true. We realize, oh, no, that's not true. Lindsay and Ashton owe us it. So we go ahead and we credit $623 to Abraham, which zeroes his account out. And they had nothing because we had incorrectly recorded it. So we go ahead and we debit their amount for the $623. And then the transaction should be okay. So here's what we do. We go ahead and we write Ashton and Lindsay, LLP for the $623. And we do the same thing with Abraham's Corporation, but we credit it. So we get it out of Abe's account and into Ashton and Lindsay's account. The problem will tell me what the document number is. Memorandum number 61. So that's abbreviated as M61. Perfect. Let's go on to the next one. Granted credit to Lambert Schools for damaged merchandise. $206. There was no sales tax from S633. Credit memorandum 29. So we just write the date. And it tells us there was no sales tax, so we don't have to worry about sales tax payable. All we have to write is sales returns and allowances, because they returned something, or we granted them credit. Let's see. Granted them credit because of damaged merchandise. This would be an allowance. And it goes right from their accounts receivable / Lambert Schools. The document number was CM29. Oops, wrong spot. CM29. And we have the full amount, which was 206. 206. 206. Good. There's no sales tax. Finally, the last transaction says, we found that a sale on account to Keller Associates was incorrectly charged to the account of Carson Properties. It's $598. So we write the date, gave us the date, 26th. We want to get it into Keller Associates account. And out of Carson Properties. M26 598 598. All right. our journal is complete. Step 2 is to post each general journal entry to the accounts receivable and general ledgers. So it's asking us to do it to the accounts receivable ledgers first. So I'll start with the account receivable ledgers, anywhere where it says accounts receivable. As I'm looking at this, I realized I missed a slash here. So we want to make sure we get that slash in there. Okay, so anywhere where it's to the accounts receivable, and also these ones, Keller Associates, Carson Properties, Ashton and Lindsay, Abraham, these are accounts receivables. Okay, so here is the accounts receivable ledger, and we will start there. I'll start at the top. Sales returns and allowances does not affect the ledger, and I can double check that because I look at my ledger and see, no, not on there. It's on the general ledger. Sales tax payable, nope. Accounts receivable, Keller Associates. Accounts receivable is not until the general ledger. So we leave that one go because we're just posting to the names right now. So Keller Associates is the first one. And this was the fourth. So I flip it over, I find Keller Associates, and I write the fourth. It was a journal, and the number was 6 for the post reference. And the credit is $259.70. A debit running balance minus a credit entry, $1,456.70. 140 is the post reference. Okay, so now we go on and we look at the next one. Ashton and Lindsay LLP. They are on our ledger, so we're going to write the 9th. It was a debit balance for $623. G6 is the post reference. And if we have a running debit balance and we have a debit entry, we add them together. $1,307.25. 120 is the post ref, and then our posting process is finished for that entry. Abraham Corporations is the next entry. We come around back. It was the 9th. G6, and it should be a credit of $623. A debit running balance, you minus from a credit entry, $1,026.50. 110 for Abraham. Okay, sales returns and allowances, nope. Accounts receivable, yes, but we want to just post to Lambert Schools. So I find Lambert Schools, it's the 12th, G6, and it was a credit for $206. Debit running balance, you subtract from a credit, $3,284, 0 cents. Post reference is 150. We flip it over. 150. Keller Associations is next. So we go to find Keller Associates, not association. Keller Associates, the date was the 26th, G6, and it was a debit for $598. Debit balance plus a debit entry, $2,054.70. 140 is the customer number. 140 is the customer number. 140. Carson Properties. Last one. We do the 12th, or was it the 26th? 26th. Carson Properties was the 26th. G6. Looks like 2 6s. G6. It was a credit for $598. a debit balance. You have to read the top. It says debit balance. Minus a credit entry should give you $1,049.60. 130 is the entry. Everything is now posted to the accounts receivable ledger, and we go through and post the rest to the general ledger. So we find sales returns and allowances, and that was the 4th, and it was G6. We have a debit of $245. And a debit running balance here. We can tell it's a debit running balance. You look at balance, debit, running debit balance. You add if you have another debit entry. And I am getting $2,732.60. Then we come over to the post reference, 4130. Sales tax payable. We have the 4th, G6, $14.70 for the debit. And if it's a running credit balance and we have a debit entry, we subtract them. $633.40. 2120. Good. Now we're on to the accounts receivable. So we have the 4th. Is the date, and G6, $259.50. For some reason I wrote this down wrong. It's $259. I wanted to double check it in the textbook. $259. Yep. So if we have a credit entry, we subtract it from a debit running balance, and we should get $8,928.05. 1130. Okay, so now we posted the accounts receivable. We already have that posted, sales returns and allowances. So now the date is the 12th. G6, a debit balance of 206, or a debit entry of 206. A debit running balance plus a debit entry, $2,938.60. 4130, and we have one more to go. We find the accounts receivable. It's the 12th. G6, 206, and we subtract them. $8,722.05. 1130. Now we can look at each ledger and determine how much each one of these companies has on an account with us, and determine how much accounts receivable is owed to us, how much sales tax payable is owed, how much we owe in sales tax payable, and how much we have in sales returns and allowances. So these are people returning their items, and it seems like we have $2,938.60 worth of returned items. Thank you for watching.